Welcome back to episode 27 of Fundraising Demystified. Today we have Paul Kromidas, co-founder and CEO of Summer, a fintech property management platform that enables investors to acquire and manage vacation rentals in a new way. They've closed over $80 million in funding, and on this episode, Paul walks us through what it's like building a company where he had no industry experience by hiring experts to fill the gaps, how he secured both equity and a debt facility by running a structured fundraising process, and how he differentiates himself with better unit economics against his competitors. As a reminder, if you're not already subscribed and you want to get updates when we release new podcasts or our newsletter, be sure to join.Thunder.vc. Again, join.Thunder.vc. Let's go ahead and get started with the show. Hey everyone, welcome back. Today we have Paul on the show with us today. Thanks for joining us, Paul.
Thanks for having me, Jason. Pleasure to be here.
Paul is the founder and CEO of Summer, and they have gone on to raise over $80 million. So Paul, I'm so excited to hear about your story, your journey, and how you've gotten to where you are today. Would you mind just giving a little bit of color about your background and what led you to starting Summer for the audience?
Yeah. Before I got started on Summer, I had a variety of roles, which I think all kind of played a role in the entrepreneurial journey in terms of getting there. Started my career in more formal finance, the credit world, sort of underpins. I still think back to some of those lessons when I'm, negotiating debt facilities and talking to lenders right now. And I think being able to, speak that language a little bit, certainly been helpful on the journey and getting to know what it's like to go into those offices and talk to those types of people. Moved over to management consulting, strategy and operations work, M&A work after that. And I have a lot to bring forth from that experience that I think led me into what I'm doing now as a founder. But then most relevantly, that world being M&A led me to Airbnb. So I was at Airbnb for a number of years, initially through an acquisition they were doing, helped them lead that acquisition, bring that company in, figure out what to do with it. And then I stuck around after that and actually led a product team there, building out consumer-facing products for a number of years, and strategy and operations work as well on the side there, and sort of had the core idea come to me while I was there. So one of the things I noticed, and anyone who's used Airbnb probably figured this out, maybe not earth-shattering information, but the quality hosts do very well on the platform. People who can drive, whatever the moniker is, and Airbnb's changed it a lot. There was super hosts, there's Airbnb Plus, now it's guest choice. I believe Brian just came out with a month ago. It's the new moniker they're calling it. I'm a guest choice as well. Yeah. Summer homes are guest choice homes. It's great. Whatever we had verified at one point, it stays on Airbnb. So they're hitting at the core principle, right? The core principle is quality stays, consistent 5-star reviews, professional photography, the amenities you expect will perform better than someone taking a home, throwing some IKEA furniture in, putting up a couple like grainy iPhone pictures, and maybe there's some questionable reviews, right? Like I've got kids. Yeah, you understand where you're coming from. Like you don't want anything to go wrong. So you want to book that, and you can charge a premium for that, and therefore, get a premium as well. Those homes are both more booked than others. The thing I noticed about, when I was at Airbnb was we could not onboard enough of that supply asset. Airbnb is a marketplace. It's supply and demand. There's a lot of demand for it, but there's not enough supply. And why is there not enough supply? So I started to think through this and unpack this. The individual owners, a lot of times, of these properties, the ones who currently own them or who want to own them, are sometimes very ill-equipped for actually running an outsource, at the end of the day is an outsourced hospitality, distributed hospitality operation, right? How are you creating a experience on the ground that is akin to staying in a hotel, right? And I don't think people stay in short-term rentals to stay in a hotel. Clearly, like you're making that decision. You're not getting the Courtyard Marriott, but you're getting a short-term rental. But I think too many people get lost in the shuffle, and they're not thinking consumer first about that. Of like, well, if I'm requiring someone to take out the trash, I mean, there's all these jokes online. Take out the trash, bag this, do this, clean this, and have all these things. Hoops you got to jump through, 5 locks. What kind of experience are you really driving? People get annoyed about that. At the end of the day, they're consumers, and not everyone is a consumer-facing mindset. So started to think through like, well, these customers who are buying these homes have a need to get more out of them or buy them new and figure out how to remove the risk in this process, because people can make money doing it, but it's very risky and it's time consuming, and people just don't understand the data that goes into all that. So the idea for Summer really came from that. Can we increase the amount of supply in a lot of the short-term rental marketplaces, Airbnb, Vrbo, et cetera, and our own platform, we rent out directly, linearizing the process. We will run homes through data and underwriting to understand actually what they're going to make, not like new stuff numbers and something way out of left field. Like we can run it through and say this home in this block will generate this much. Jason, whether you already own the home or want to buy the home, here's what we can do to maximize that. We will finance that purchase for you if you want to buy it new, or we can finance improvements you'd like to make to your current property. And then lastly, we will manage the home, price the home, generate the yield, but do it with a trusted brand in front of it, Summer Homes, that is well known to renters and owners alike as a quality owner operator of these assets that cares for them like their own. And we find the feedback loops on that are very strong in building a network that resonates with consumers.
No, I'm glad you kind of walked through and gave us the overview of Summer, and also just walking through the background and just how relevant your background was to starting this, and especially having the insights at Airbnb and being able to see the supply and demand problem that was there. Did you ever have your own property prior to doing this yourself, or did you kind of jump into it?
It's crazy, actually. No, I did not. I did not own or operate a short-term rental officially. I had been adjacent to it for many years at Airbnb. I'd looked at the numbers. I'd do a lot of owners themselves, and I wore a bunch of different hats at Airbnb, but my last hat I wore was on the product team. Obviously, one of the big jobs of any product person in any business is consumer focused, right? You're understanding who you're building your product for. You're understanding the customers, right? And oftentimes at Airbnb, who are the true customers in the marketplace, it's your supply and demand, it's your hosts and your guests, right? And I had the fortune of being able to work on both ends of the product, and you're talking to hosts constantly. And one of the things that Brian always emphasizes is how important hosts are. You walk the halls of Airbnb and you see pictures of actual hosts to remind you, like, this is, here's Jason, and he has a property here, and he lists on Airbnb, and there he is. I had some great black and white photo, but it's true, and you can't help but remember you're doing this for Jason and other people out there to list their homes and put them on this platform and create that brokering of supply and demand. But you're getting to know their pain points, you're understanding what that problem is and trying to solve that for them. I think Airbnb is traditionally why I jumped on this opportunity was Airbnb is a marketplace and they'd like to remain a marketplace. So keeping things that are both operational and financial for them at an arm's length, I think is very important. And that's, an opportunity for us here to obviously do something both on those angles, but also through the technology.
And I think you guys have done it a little bit differently than some others. And, I'm really curious to learn, one, the show's about fundraising, but I do want to just kind of get down to the model behind it, because you guys raised a sizable debt facility to make this a reality. And, whereas most people are maybe just overglorified property managers, you actually are financing this side of the deal. And so I'm curious at how you guys did that and why you chose to go down the financing route, taking on that risk along with the homeowner.
Yeah, it's a good question. I think the initial thought was we wanted to try to help more people become owners and operators of these homes themselves, or owners of these homes, and be able to get that experience of owning a vacation home and do it in a way that made sense, right? That was sort of the crux of the original idea that I was putting out there. And, I think one of the things we realized is as we were doing this was, hey, we're building this model top of funnel, this algorithm top of funnel that's proven to be really accurate in finding the right homes and sort of informing our investment decisions here on, how can we help you, Jason, if you're someone new who wants to buy a vacation home, like you're coming into this market, you're driving, I'm sitting here in New York City, you're driving upstate, Hudson Valley, you're driving to the Hamptons, and you're looking at homes and you're wondering, is this home good, or is this home good? Or, I kind of want to do this. And getting those people, there's a lot of people in this tiering, what we call sort of like the mass affluent, the middle upper class. Like, what's interesting about that group is they have the funds, typically, they have the money to actually transact and buy a decent home. It may not be like a mega mansion, but it's a decent home. A lot of people would love to stay in it. It's actually, those are the homes that perform best via short-term rental. They're not the mega mansions. They're typically like just the really nice properties, right? But what's interesting about that customer is they have a higher risk tolerance despite having the money, because that money that they have, or the asset that they've already bought, represents an outsized portion of their household savings, or them and their spouse, or maybe just them. So they're more thoughtful about it, and they want to make sure they're not making a stupid decision, or a decision that's going to put them in a hole. And I think that was the insight that I stumbled into was, hey, there's a lot of people who already own these homes who are looking for sort of more yield out of them, right? We can help them out and tell you where to invest in, what to do and say like, improve this, improve that. We can help you finance that. And then on the other side, we have this model called gradual ownership, which if we find a home that we're that confident in, and it all starts with that technology, like I mentioned, I realized that we're building this technology to make our own investment decisions. We can afford to take the risk because the risk isn't really there if this is as accurate as we built it to be. And so far it has been, where we are able to say this home is going to predict this much. I'm that confident in it, Jason. I'm not just going to tell you it's going to predict this much. I'm actually going to buy it for you, let you rent to own it for up to 2 years, and I'll show you myself. I will rent it out when you're not there. I will show you what we get on it, and it's going to match up with what I told you it will. And then, at that point, you're buying it back, hopefully buying it back from us as de-risked as it can come, because you're seeing we're excellent management that we put forth, the 5-star reviews we're getting, the yields that we're getting on the property, all in that interim period. I'm comfortable taking that risk because I'm that comfortable in the numbers for top of funnel underwriting. So I think it was initially a creative wedge to both differentiate ourselves from the rest of the ecosystem out there of, sort of just straight property managers just taking whatever they can get and like trying to, squeeze them for all they're worth, but also a way to create more TAM in this marketplace and create more owners in this ecosystem that makes sense and get them on a risk-free way.
No, and that's good context. And, when it's, having, being in the fundraising space and seeing lots of companies come by, I think you have a good model, but inherently still like heavily dependent on real estate. And when going out and raising capital, a lot of VCs see these models, linear growth, real estate. Where's the tag? Why are you raising so much money?
Yeah.
So, what was your fundraising experience like in the early days? When you kind of got your first initial round, kind of walk us through what your strategy was. How, was it cash right off the get-go, easy as can be, or was it a crazy journey to kind of find your fit there?
Yeah. Well, I mean, we raised our first round of institutional capital, our seed round, at the end of 21. So certainly, was a different world for a lot of people, right? In a lot of ways, it's funny. I look back at it now, and I have mixed feelings, really, because I hate it because I think obviously a lot of valuations and expectations were just inflated for a lot of people, not just our company, companies throughout prop tech, fintech, the entire ecosystem, really. Probably everything was overvalued, which I think sets up companies poorly down the line, especially companies that took a lot of capital in those environments, right? We were fortunate enough to really only take one round in that, crazy environment. So there's a lot of time to sort of right size things to more, achievable valuations, let's say, as you track your company and grow it, that I didn't really understand before I came in and started understanding the fundraise game. And, you get presented with a term sheet in 2021 and your valuation's this, and you're like, that's amazing, right? Like, I'm worth this money. I did it, right? But you realize that really quickly that you got a long journey ahead of you, and there's no guarantee of an exit, and you've got to prove that valuation, right? Every time you get a term sheet, you're now getting notched up a bit, and you're notched up a bit, and you're notched up a bit. And if you're not actually justifying what you're valued at on paper in private markets, like that will bite you eventually, whether it's now or 6 years from now. And I think you see that throughout the entire ecosystem, right? So I think that was the negative. I think the blessing from it, honestly, when I look back is, and a lot of people have told me this, like, wow, you had, sort of like perfect founder market fit for the idea you're going after, right? You worked at Airbnb, you had product experience, you had strategy, operations work before that, you had finance work before that. Like that's literally what it takes to get something like this off the ground. Of course, like, VCs are going to be interested in talking to someone like you. And that was correct. But I tell people all the time, had I tried to start this business this year, I don't know if I could have even done it, because I think there is an initial quantum of capital that it takes to get something like this off the ground. And that unfortunately is just not here without some type of traction or evidence in like 2022 or 2023 and I think into 2024. So I think I needed the initial environment to get that injection, but then, I'm glad it was able to get into where we are today, I think, because it's a more healthy environment, provided you can fundraise.
Yeah. And I think that's very insightful for your, being able to reflect and acknowledge that, because I think that, is true for a lot of different businesses, but you were smart enough to realize it and pace yourself accordingly. Where I feel like a lot of other companies took that money and lit it on fire as fast as they could, thinking there was going to be twice as much a few months later.
It's tough, though. I have a lot of sympathy for some of those founders. I do. I think especially the first time ones, right? and I can empathize with this being a first-time founder myself. You think that I think it's a journey for a lot of founders to have high conviction and high confidence. And I think a lot of founders don't want to admit it, but most people have, and most people in any walk of life, when they're doing something new, they're stepping into a new role, there's a bit of imposter syndrome. Yeah, you're running a company. All of a sudden you're the CEO of a company and you've got some money, but you've got a big name investor telling you to do X, Y, and Z, or you've got, Sequoia's not on my cap table, so I'll just throw the name out, but they're big name, like Sequoia's telling you to do whatever, or SoftBank's telling you to do whatever, right? Like you're saying to yourself, wow, that's so-and-so, or these people know what they're talking about. And, not to say that they don't know what they're talking about, but they have different objectives than you, right? And I think you realize that as you grow as a founder, as you grow as a CEO, their objectives are different, and doesn't mean they're wrong or bad, but you have to understand that. You have to understand why they're telling you to spend the money, what they want out of that, and what their end result that they want for your company is versus what you might want for your own company. So I think it was very easy for a lot of folks to just get that money and sometimes even have strings attached of like, you have to go spend it. So yeah, I feel fortunate that none of that happened with me, but I have a lot of empathy. I think it gets kind of blown up in the media. Like founder X pulled in all this money and blew it yesterday. I'm like, there's a lot of people around the table that condoned that blowing of $100 million. It wasn't just that person. Sure, it was ultimately their call, but like, you don't know what was going on in the boardroom or behind the scenes with some of this stuff.
Yeah, that's a good way to put it. It wasn't like it was a runaway founder that had no oversight of any kind.
There might be a couple of those stories out there that we've heard the last few years, but I don't want to judge everyone off of that. Let's put it that way. But yeah, there's someone you're scratching your heads. I won't name names. You're like, oh, did they have any diligence on that? What was going on there?
The answer. So you leverage the timing. You get a sizable seed round, $11 million, massive. And then, but you come out, I guess, when did you close your Series A?
We closed our Series A over the summer. So we recently announced it about a month ago, primarily because when we first closed, we got a lot of bounce backs from reporters over the summer saying, hey, out of office, don't talk to me right now. So I was like, oh, you know what? When I started digging with a couple of folks in September and, got a small add-on or two, and then, was like, well, I got to get this announcement out there before the end of the year. Yeah. It's been sitting over me. So we were fortunate enough to close it over the summer and pick up a little bit more along the way. And recently got it out. So it closed an $18 million seed or Series A, I should say. Yeah. This time I had co-leads involved, which is interesting, but it's certainly a different ecosystem to raise in than 2021, night and day in a lot of ways. Super fast in 2021. I think it took us, I want to say from the time we started to the time we actually have money wired, maybe 2 months, 2021. I think we went out there in early October and we were closed with our seed by Thanksgiving and right around the early part of December. And we, had multiple term sheets, fortunately, and it was a very different environment. And then the Series A rolls around, and I think if a founder hasn't gone through it already, they will. And it's I tell everyone I talk to, it's a very different world out there. The biggest piece of advice I'd give to people is like, make sure you give yourself time. It's not impossible, but it is absolutely harder. And the tables have turned where, in 2021, there was so much capital to go around. VCs were looking for places to stuff it, right? They needed to deploy their own capital. And now it's the opposite way. They don't need to deploy anything. For anything, they're kind of safeguarding it. And they've got 10 companies they're looking at, and really only enough powder to do 2 or 3 deals. So, it's possible to get a deal done, but they're going to be very picky and choosy about who they invest in, why they're investing, and they're going to make sure that diligence takes as long as they want it to take. So give yourself the extra time. I tell people, give yourself, take whatever you think it's going to take you and add 3 months on at least, because that's what you can expect out there right now.
I would completely agree. That's exactly what I'm seeing in the market. And once you actually finally get down the funnel with VCs and you get a term sheet, you think you're done. It's like, no, there's a lot more to go.
Just the beginning. Honestly, like it's great. It's a checkpoint, but like until the money is, that is something I'm sure a lot of other founders have learned too. Until the money is in your bank account, you are not done. And things can happen along the way. And I've either had it happen or I've heard of other people, and I'm sure you can test as well.
Oh yeah. I've had term sheets pulled, a couple weeks after being issued. Granted, it was a pandemic. It was March 2020 when I had a term sheet pulled from us, like Series A term sheet, like, we did it, yeah. It was like, no, goodbye, all done. Never came back.
Did you know that most founders waste days of their lives chasing the wrong investors? Well, as a founder, you know your time is your most valuable resource. Don't waste it on the investors that aren't going to write you a check. Here at Thunder, we built a free tool that identifies exactly which VCs are worth your time to pursue. We score your company against 3,500 VCs and family offices that have been vetted and are actively writing checks into companies like yours. Get your AI recommended list of investors that will look like this absolutely free by creating a free profile at Thunder.vc. You can upgrade to premium to download this list, export it to any tool you wish, and get their contact information and access the data on their portfolio companies to map out a path to warm intros and build your founder network. Sign up for free at Thunder.vc. Now let's get back to the show.
So all right. So you 11 million seed, you go on and you get the A done. But why did you choose your strategy around the A? So you raised 18 million in equity. You also secured a $50 million debt facility. What I want to understand is, what was your strategy on deciding on those two vehicles and the amount of those?
I think, well, stepping back for a second, it really, I remember, honestly, I sat down initially in August of we're sitting here at the end of 23. I sat down in August of 22 and said to myself, like, hey, we should go out and fundraise. Like, I think we should start getting things in order, because I don't like where the world is heading right now. I'm seeing the storm clouds already starting to form. This like summer of 22, if you can remember, like, wasn't complete doom and gloom, but interest rates were shooting up really fast. And I'm saying to myself, this doesn't look good. I don't know how long this is going to last, but I want to make sure we batten down the hatches and, make it all the way through. I should try to go back out and see if we can get something done. We've got enough initial traction. We've got initial product market fit. Let me go do that. I brought that at first to the board and some of the insiders and said, hey, look, here's what I'm thinking. This was the fall of 22. Like, I'd like to go out and do this. I'm going to go out and do this. So you're all aware. I'm going to go out and fundraise an A. Would love your all support in that process. No expectations other than that, right? Just support, I think, is all you can expect from your insiders, whether they put money in or not. At that point, I had the fortune of one of our insiders actually saying, hey, well, before you go out there and, talk to everyone, maybe we're interested in beating the A again from your seed. And they dug in, and, they liked what they saw and presented a term sheet towards the end of 2022. Which traditionally, looking back again, if founder hasn't realized this yet, don't start fundraising right now. This November and December is probably the worst time of the calendar year outside of, the summer to raise from VCs. Like, there are windows of the year you want to be ready for. And I think, again, something learned now, you want to be ready to go on Labor Day with your fundraise, and you want to be ready to go on January 2nd with your fundraise, right? And you want to have it wrapped by 4th of July, and you want to have it wrapped by Thanksgiving in both of those seasons. Don't raise in the 4th of July to Labor Day, and don't raise in the November, December windows. So I figured that out really quickly. Hey, a lot of quick diligence, but then I'm busy with this or holidays, or let's check back in January. And I'm like, okay, this is going to take a little bit longer than I initially anticipated. And sort of step back literally a calendar year ago today, re-architected, rethought through how we were going to market, what we were going to market with, what the initial feedback points I had heard were, and decided to really hit the ground running in January with a much more aggressive approach to getting it done. But the impetus to raise really just came from, hey, I want to grow the business. I think we're doing something compelling here. I got that validation from insiders and obviously some outsiders, because it was an outside and an inside led round, which was great. And I want to make sure we've got the money to carry us through that growth responsibly over the next, call it 2, 3, 4 years, in a way that, I don't know how long the interest rate environment's going to be, how long, this pseudo recession we're in, or whatever you want to call it, is going to be. I hope and think it's probably through 24, and then I think hopefully clear skies in 25.
Yeah, I'm in a similar camp in terms of where we see things going macro economically. But when it came to that strategy, so it sounds like you had some internal discussions and then kind of really, button down the pitch and the story in January. So it really came down to like how much time you'll have with that capital. And as far as like milestones, is this profitability round? Is this the growth round? Like, what do you guys do with the business? Do you think you're going to go back out for another sizable raise? Do you think you need to?
Yeah. I think, I also learned, I think there's something to be said for being opportunistic, right? I had this, I had this very naive mindset as well when I first raised the seed back in 21. Like, I probably, looking back, I probably could have picked up a few extra $1 million after I closed the round and announced back in the end of 21 from people who were just heard about it and were like, hey, I missed you and I really like what you're doing here. Can we do something? Can we dig in? I kind of had this like evergreen mentality of like, oh, that'll always be there. I just, closed the round pretty quickly. And like, I'm sure there will always be more capital whenever I'm ready for it to go out to market. And a lot of founders had that mentality before the last few years. I probably should have been opportunistic about picking up a little bit here and a little bit there. I don't think a lot of people regret that if they do. And, I think, so the door's certainly open on my end. I don't think we're aggressively going out and fundraising anything in the near term future, given, what we were able to do. But opportunistically with the right kinds of partners, for sure, I'm open to digging in and taking out some more. I don't think we're going to need a giant slug of capital to grow the business. I think the idea from this fundraise was responsible growth, but also hopefully focus on profitability. And I think we've got a couple plans in the works to get there. Whether we do or don't, we'll see. But I think that's definitely the goal internally. I'm trying to run the business assuming I don't raise any more money. What happens in a world where, real estate crashes and no one ever wants to write any checks into anything looking remotely adjacent to homes or fintech or anything like that, right? I think seasoned founder mentality, expect the worst and prepare for that and be surprised pleasantly if it doesn't go that way, but you're ready for whatever can go wrong.
Yeah, no, I would agree with that. And then, when it comes to your business, like you kind of mentioned this earlier, like there are other players in the space that have gone on and raised venture capital, some notable ones that, unicorn status, this type of thing. But I feel like your business is a little bit different. What was like, given your adjacent, focus to real estate and how, how did you decide who to go to raise capital and how did you get introduced to them? And kind of like, how are you differentiating yourself from those other players, as well as being able to kind of get more of a venture-backed, outcome?
Yeah, that's a good question. I'll tackle the latter part first, and then I'll talk about who I went out to and why. I think our differentiator here, and what I've really tried to lean into, is like, look, is there a component of our business? Like you can point to various pieces of our business and say that looks like this company, that looks like this company, that looks like this company. And I think something that I had to contend with in the fundraising process was that to some extent, like a lot of investors or founders that have gone through the process will hear investors talk about what's your comp, right? How do you comp to this company? Or how do you comp to that company? And a lot of people don't get that before they go through the process. Like investors are looking to take a look at you and your company and say to themselves, okay, it's pattern recognition, pattern matching. It's like this thing looks like that thing. That thing trades at this on public markets. And they did that within this amount of time with this amount of capital. Okay. So here's how this thing is going to go, right? They want to try to create the guaranteed outcome in their head, or at least extrapolate it so, they can say to themselves, well, I did the work and that's what it looked like. Unfortunately, I think the best companies out there are the ones who don't have an exact comp. By nature, it is somewhat of a fallacy to just say that like, I'm going to invest in this thing that looks like that thing, because you want to be investing in the things that are new and differentiated in some way and inherently don't look like the thing that's already out there, right? Or they look a little bit different. And that takes a level of sophistication, I think, from a venture capitalist that, and again, not naming names, but isn't at every firm and isn't with every VC. Some of them want something that's just more simple. Divide this by this and go off that, and that's that. I think other folks try to do something a little bit differentiated and try to create the differentiated returns. And I think those are typically the investors you should try to seek out as a founder earlier rather than later, because whether they invest or not, they're going to give you good feedback on your business because they're going to be thoughtful about it and they're going to be inherently want to do the work. That was a quick aside that I think is relevant for a lot of founders to understand. But we try to differentiate ourselves mainly around a few areas. One is brand. I think when you look at the space in the prop tech, this community, this area, fintech, anything, there's a lot of like deep blues and sea greens and like psychology in that, right? They're like trusted colors, like banking colors, right? There's a reason that JP Morgan Chase and all these companies have like dark blue as their color, right? Like there's psychology behind that. There aren't really great consumer-facing brands in this space when you look around, other than Airbnb maybe. And I think that's part of my DNA that I brought to the table. I was like, look, I saw what Airbnb was able to do. Like, why are they different than Booking or VRBO? Like, they lean into the brand, they lean into the story, and Brian's a master storyteller. He is a master at getting people to believe in the broader vision of this platform. At the end of the day, like, you strip away the story and everything, it's a home sharing platform, right? Like, but Brian's been able to buid a brand around that. And that's not meant to be derogatory in any way. Like, it's masterful and how he's thinking about growing it and these product launches he's doing, right? But it's something I always took away from my experience there about how important a consumer-facing brand is. And I think there's a lack of that in the space. So when you think about, I thought about leaning into my differentiators as a way to target investors. So I have a consumer-facing brand I'm trying to build here. I should go talk to investors who value consumer-facing brands, right? Whether they like prop tech or not is somewhat irrelevant. Some of them did, some of them didn't, right? They're like, hey, I like consumer-facing brands, but I don't like things that are in real estate or real estate adjacent. Love what you guys are doing. Give me some more proof points. We'll go from there. Some did invest and they were just like, I love the consumer-facing brand. Let's go. Separately from that, I think there's obviously a fintech component to what we do, right? Like, there's this, we're buying some of these assets, we're holding them, you're renting to own them. That is a financing mechanism that I think appeals to fintech investors and folks who very much understand cost of capital, debt capital, all of that, and being able to differentiate ourselves from other players in the property management space or anything like that who aren't doing anything like that was important for those investors, right? So then you're kind of going out and targeting those folks and saying, look, I've got something very differentiated. We're not this, we're this. And then lastly, I think the technology piece, like top of funnel, like, hey, we're doing this thing around like underwriting technology, et cetera. And you've got folks who are interested in that. So I think I always tried to take that approach when I went out to my list of folks to fundraise and said, look, who are the people who are subject matter experts and investors in these pockets, and go off and attack them. Attack is probably too strong of a word, but go after them and try to get the intros and try to get in front of them and show them what we're doing. And they will work backwards and understand how I'm different than everything else out there by combining these things together versus some of the more generalist funds. I think that the generalist funds probably are a little bit more risk averse in the sense that they don't necessarily have an expertise in one thing. So therefore they are looking for the thing that is easy to underwrite and easy to understand and just say like, okay, this makes sense. I get it. The subject matter experts I found, because they have conviction, they know their space very well, can spot the thing that looks different in a good way, a little easier.
I think it's really important that you identified how you had to take your business. You didn't change your business. You just told a different narrative to the different investors that had different thesis. Mm-hmm. And I think it's so important for founders to think about. They come in and they're like, they work on that 90-second elevator pitch and the same pitch over and over and over and over again. They don't realize, like, on the other side, investors are trying to put you into a box that they understand.
Yep.
And if you don't give them the information that they need to put you in their little box that helps them compute, the opportunity, then they just feel like you're too early or you're,
exactly.
like you're not a fit. And they give you these generic rejections.
It's so important, Jason. There's one thing I also have to say off of that, because you're spot on. Someone, I can't take credit for this. Someone told me this. They're like, one of the things I stepped back and did last year before I went out in January and really pushed my fundraise was I wrote an investor memo. I put my product hat on and I tried to have empathy for my customer. In this case, my customer was venture capital, right? What do they want? If I were sitting in their shoes, what would I want? I'd want someone, if I think this thing looks different and it's hard, and inherently I'm a person who, like most people, don't want to do the hard thing and put the hard work in. I want to do the easy thing, right? I should try to make their lives easy and do their job for them, because it's that important to me to get this capital. So I'm going to write my own investor memo answering all of their questions that they would be thinking through and putting together on their end for their investment committees, knowing their process, knowing what they're looking for, just like you said. And I got a template from one of my inside investors of like, hey, how do you structure these? I'm not a VC. I've never written one. It was a great exercise. Honestly, like separate, I'd encourage everyone who's thinking about fundraising to go out there and do that, because you will look at your business through a new lens and be able to go out and say, look, oh, they're thinking about this way, and here's what they're looking for. If I can just serve this to them very easily, it makes it so much better of a process, and they'll want to dig in with you more.
And that's essentially, you're running a sales process. You're selling to a customer. In your case, you're trying to get someone to give you their money, and you're giving them the opportunity, the deal. That money will become more over time. It's still a transaction that I think a lot of founders realize. Founders that run a process successfully ultimately look back and say, "I ran a sales process."
Yep, 100%. You're a salesperson for yourself and your business.
Exactly. It's one thing to you talked about the VC side, and how you approach them, but when it came to deciding on how raising that $50 million debt facility, what type of who did you go to? How did you structure that? It's a world that a lot of founders don't really have a lot of exposure to. They think, I only can raise VC, but in your case, it's a little bit different because it's asset-backed opportunity. But how did you approach that? Who did you go to, and kind of how did you structure it?
That is a great question. I think your first point that you made is very true. Most founders don't have an experience in that. A lot of founders, maybe they have fundraising experience from VCs, maybe they don't, which is still a big thing, but definitely not debt capital. Unless you're coming from that world, unless you've worked in structured finance, you've worked in traditional finance, it's a very hard world to wrap your head around. And even, Jason, I know you've got a bit of a background in it as well. Even the little things of just knowing what it's like to be in a bank, literally working in a bank, being in a bank, engaging with those people, how they dress, how they talk, what they're looking for, right? Like that was much easier for me to sort of like, almost like wear that skin when you're walking into that place. Like they're expecting you to be a founder, right? They know that you're not a banker, but like a good salesperson, you want to speak the language of your customer. And in this case, these people talk differently and act differently and have different objectives and mindsets than VCs do. And, Propco equity does, or family offices do, right? Like, so I think for me early on, it was a recognition of, hey, look, I can speak that language. And I know enough to be dangerous, but I'm certainly not the 20-year, sort of subject matter expert at that capital and raising that. I've got enough of that in my background that I can speak the language and I know what I'm talking about, but I know enough that, like, I would say when you look back at this, a lot of companies that raised bigger debt facilities, whether it's in prop tech or, fintech or other types of spaces out there, what a lot of founders don't realize is actually there's a lot of like hidden terms and hidden things. Hidden is maybe, too insidious, but they're just terms that you don't understand as a founder because you're not coming from that world, right? What are the covenants that you're signing up for? What's the level of liquidity that you need to maintain in your business to continue to have that facility before they're going to call time and just take everything from you, right? Like you can run yourself out of business by signing up for the wrong things and not knowing what you're signing up for very quickly and very easily. And that didn't happen 5 years ago because money was abundant and free flowing. But you've seen a couple businesses the last few years learn that the hard way. And I never wanted to be that business. So one of the things I did early on was find a capital markets advisor, someone who had significant experience in the space. In this case, this person, is a managing director for 20 some odd years at JP Morgan. So he had left and was looking to advise early stage founders, and was connected to him through one of my investors, and had a great relationship. He helped advise me, helped me see around the corners, redo these agreements. We'd step through them, walk through them. What does this mean? What does this mean? You're trying to learn effectively capital markets and 2-month, 3-month process. And he ended up coming on full time, and he's now my CFO. So, shout out to Jim. He's been great. But, I joke with people a lot of times. I'm like, you have to assess yourself. If you don't have that thing, it's like hiring in your own business. If you're not an engineer, then you should go out and find a rock star head of engineering. If you have a business that deals in debt facilities, you don't have that background to the level of depth that I think a lot of people really need to sign up for those and have high degree of convictions, and you should go find someone who does, right? In this case, I did. And I think that was, it's advice I've given other founders who have done this, and they've all said the same thing. You absolutely need someone like that who can tell you what you're getting involved in and help you see around some of those corners. Because you could sell, you can talk about your business, you're a lot of founders are smart, they're charismatic, they're confident, they know enough to be dangerous, like I said, but they don't know every nitty-gritty detail. And I think when you're raising debt, there's a lot of things that can go wrong.
No, and I think that's something, when I write checks and invest and stuff like that into companies and or choose to work with companies, I think it's something where you just kind of said there was like, know when to bring in the expert, know when to bring in the right people to solve a very big problem.
Yeah.
And in this case, it sounds like you followed that to the T. And I think that's something that's really important as a leader and a founder to recognize and execute on. And, because at least I follow this tendency sometimes in my own businesses where I was like, I got to figure it out myself, but sometimes it's, And sometimes it's, like if you've raised money and you're growing, you're scaling, you have resources, you
Yeah.
get those resources to deploy them on better people and smarter
Yeah.
people that have the experience. So, kind of skip the learning curve if you can, when you can. As we kind of, come to a conclusion on the show here, what's some advice that you have for founders that are out there that are either considering raising capital or planning to raise capital?
Yeah. Well, I mentioned one, start earlier than you think, and especially in this market, it's going to be longer probably than you think it will, if it happens at all. Second, I think have empathy. We talked a little bit about that. Like, something from writing my own investment memo. Try to think about, what are the objectives you're trying to accomplish and what are their objectives. Again, you're running a sales process. You want to make this thing as de-risked as possible for your venture folks that you're talking to, and what are they looking for? How are they viewing this? I think another one is, move fast, cast a wide net. I think a lot of people that I've talked to are very methodical with it. And I think there's nothing wrong with having a methodology. It doesn't mean you're disorganized, but they'll go one by one by one by one. I started doing that at one point, and then I realized, like, what am I really doing? I should be having multiple conversations and parallel pathing things at the same time. And, there's no harm in having multiple conversations open with multiple players at once. And you can sort of, I took it from going through waves almost. So you can't have 50 open conversations, certainly, but like, maybe you push out 10 and, 5 get back to you, and then you're digging in with 3 of them, right? And then like 2 weeks later, you're pushing out 10 more, right? Like you're kind of moving on this rolling push of outbounds that you're trying to get out there. So I think, don't be afraid to move aggressively and quickly, but, run a structured process. And then I think, 2 more quick ones I'd say are, one, don't take it personally. Founders are deeply driven people inherently. That's what attracts you to doing this job. There's little gratification in it, at least early on. If it goes the right way, maybe there's some down the line, but you're kind of slaving away on this thing, and it's your life, and you see it for all the roses that it's going to be one day. It can be deeply personal and feel rejecting to get rejections and have people say no. There are a lot of things, and I've had people tell me this after I've run processes with them, or even, other investors who invested or didn't invest, and say, look, like there's so many reasons why founders can get rejected. Maybe we just did a deal in the space that was unannounced a month ago before we met that person. We might like their company, but we're not going to invest in a company that's adjacent to that other one, but we haven't announced yet, so we have to say no. Maybe we don't have the dry powder people think we have out there right now. So, and we don't want the market to know that we don't have more dry powder to invest. So we're going to say no, right? There are so many reasons that are out of your control. A partner could have woken up on the wrong side of the bed that day and squash something, even though a couple more junior folks really like it, right? Like there's internal politics, they're their own beast, they run their own processes. The best thing you can do is just ask for feedback if they're able to provide it. And if not, thank you very much for your time. Don't have the reactions, like crazy things. Like, this is a long game. You never know when things are going to come back around. And I think the last thing I found extremely, extremely valuable, Sam Altman has a great talk on this. So one of the things he looks for in founders is tenacity, and just like, you will get beat down. You will have your face shoved in the dirt. You'll feel like everything's just raining down on you at various intervals in this journey, especially in fundraising process, especially in this environment. I just kept telling myself, like, I'm going to get it done. I'm going to get it done. I'm going to keep talking to people until we get it done. I'm going to get out there. I'm going to keep recalibrating things. I'm going to keep getting it right, and we will get it done. And there's no other option. We're going to get it done. And almost like you have to have this mantra and this confidence around it, and you have to almost prop yourself up in a lot of ways, because it's lonely and it can feel rejecting. But if you have that grit and that tenacity, you will find a way to figure out how to fund your business, whether it's your venture money or something else. And you'll know when maybe it's not the right time to do it, and maybe you have to recalibrate and step back. So there's my parting thoughts for folks.
I appreciate it, but also you gave me a little bit of PTSD on some. My bad.
I still have it.
Yeah, I remember these moments. I don't want to remember that.
Nope.
Yeah, no, I appreciate you sharing those insights. For the founders that have enjoyed your chat with me, what's the best way for them to learn more about you in Summer?
Yeah, I'm on most large social media. I'm not on TikTok, so you can't find me doing any dances there, but you can find me Paul Kromidas on LinkedIn, X, etc. And then You can check out Summer if you're interested in either owning a vacation home or getting more out of your current home, or just staying in a great home as well. We got a lot of great homes throughout the country. We'd love to host you. So check us out at www.gosummer.com and across all of our social media handles at Start Summering.
I love that. I want a summer, especially now as I look at rain outside my door. I'm like, whoa, summer sounds
Summer is
nice.
a state of mind. Summer is a state of mind, right?
You love winter sports, so it's like, it'd be totally fine going up in the mountain, but rain and cold. It's got to be snow and cold. That's my thing. Well, appreciate you being on the show, Paul, and your insight's been super valuable, and I hope founders are able to walk away with some nuggets of information here.
Thank you very much for having me, Jason.
All right, have a good one.
Thank you, you too.
Thanks for listening to the show today. We hope you learned something valuable. And if you did, be sure to let us know in the comments or by hitting that like button. And if you're a founder looking to raise capital, then join us at Thunder.vc. We provide a free tool to help you identify which VC, family offices, or lenders are the best fit for you using our AI. It will save you a ton of time from chasing the wrong investors. And since launching our free tools, founders that have joined our network have gone on to raise over $1 billion in financing. Again, you can find these free tools at Thunder.vc. And as a reminder, we release new episodes every week. So stay informed by subscribing to our newsletter at join.thunder.vc. Again, that's join.thunder.vc. And if you or someone you know has recently raised a round and want to share your story, please email me at jason@thunder.vc. And that's our show. We hope you enjoyed it, and we see you next week.